Hello and welcome back to Nolan Financial Radio. My name is Chris McKinney from Nolan Financial Partners. If you'd like more information about what you hear during our show today, give us a call at 719-210-4242 or visit us online at our website, nolanfinancialpartners.com. And while at our website, click on the radio page, check out our past shows, and subscribe to our program on Apple Podcasts, Spotify, Google Podcasts, or Amazon Music. As we rapidly head toward the end of 2023, there are some potential valuable tax and financial strategy steps that you can take right now that could benefit you both this year and next. Whether it's taking required minimum distributions, increasing your retirement contributions, or donating an IRA distribution to charity, there are several important things you can discuss with your financial services professional during the next few weeks. But before we get to what we're going to talk about today, let me introduce you to my co-host, Tony Shore. So what kind of year-end financial strategies are you going to take there, Tony?
Wow. Well, I'm going to plan out my trips to the pizza buffets. That's one financial strategy, and calculate that cost. No, I'm kidding. But yes, we definitely need to have a financial strategy. I think you want to replenish that savings account, the emergency fund after I dipped into it to buy records and pizza. Got to get that back into shape and all of that good stuff. But it seems like the perfect time to talk about year-end planning steps. So I'm glad you brought that up. But first, how have you been? What are you up to, Chris?
I've been great. We did a bunch of traveling. And so it's nice to starting to get back into the groove of being here and seeing clients face to face versus online.
Yeah.
Because we traveled for about 45 days, but we still talked to clients. We still met online and did those kind of things and got money moves, money moves, right?
Money moves. I've read the book. It's awesome. Yeah. And so for our listeners out there, we haven't talked about the book in a while.
No, we haven't.
But they need to get Tara Nolan's book, Money Moves, right?
That's right.
Yeah.
Yep. You can find it on Barnes & Nobles or Amazon.com, wherever you want to find wherever you find your books.
And if you call Chris and Tara, if you call Nolan Financial Partners and set up that no charge, no obligation consultation, you will get a complimentary copy of the book. Is that correct?
This is correct. You're letting the cat out of the bag. I usually surprise people, but you know what? It's time to just let that cat out of the bag. And
I just want to let our listeners know as an added perk, and this isn't just some pamphlet. Everybody says get this free book. This isn't some 50-page thing. This is a actual book with interesting stories, facts, charts, graphs, lots of information on all different topics to get your finances in order. So it is well worth the price of admission. Go online, purchase one today. They're not very expensive. Money Moves by Tara Nolan, or you can just set up a consultation and get a complimentary copy.
That's right.
Excellent.
So give us a call at 719-210-4242 to set up that complimentary consultation and receive your free Money Moves by Tara Nolan.
All right. Well, where do you want to begin our conversation about some year-end strategy steps?
Well, so it's the end of the year. So it's the end of the fiscal year as well for most people. And so this is a time that tax moves become pretty important, especially for retirees, because taxes was one of the biggest drain on their finances is having to pay taxes. And so I begin with Roth conversions. So there's a period between the time you retire and the time that your Social Security kicks in, your required minimum distributions or RMDs kick in. it's called the valley. So it's a time when your salary is gone, so your income streams have dropped to nothing until your Social Security and required member distributions kicked in. You're living off your cash usually. So this is a great time that you do Roth conversions. So maybe putting off that Social Security can help do this, so that you can take advantage of moving that money into a Roth IRA, a personal Roth IRA. Okay. So during your working years, the biggest component of your taxable income is your wages and other business income. And then when you get into retirement, that starts with Social Security and RMD. So your taxable income goes up. Well, so this is that time between that. This is the time to figure out a plan. So you need a plan to move the Roth IRA accounts because there are a lot of things to consider about it, and then you don't want to take all the tax hit in 1 year. So it's a good time to start looking into the strategy. You need to know what all the ins and outs of it are because it's a little complicated. It can affect some of your other things that's going on. So you'll want to make sure you talk to somebody that knows how those things can affect you.
Well, right. And I think if a Roth conversion sounds like it might be something that will work for your overall strategy,
Yeah,
you want to make sure you only make this move while working with a financial services professional like yourself
right.
alongside a tax professional, right?
Yeah, there's so many rules around conversions, and you don't want to get hit with taxes you don't expect. So,
Right.
or other things. There are some other things that can impact.
Well, sure.
So the other thing that we like to do at the end of the year is realize some capital gains or capital losses. Um, if you have a stock portfolio, brokerage account, capital gains is another area where that valley comes to play. Take your gains during the valley, right? So use that opportunity to spread out some of that taxable gains. Hopefully, they're long-term capital gains, right? And so you have to know what income tax brackets are for those, so that you stay within um, the the rates, because it can be 15% or it could be 20%, right?
Right.
So most people will pay 15%. Now, if you're in a income bracket of 12% or less, then you pay 0% in capital gains. Well, guess what? You just separated from your job. So maybe you are down in that income bracket. Maybe you can manage it so you to pay 0 on capital gains during this period. So wow, what a time to start moving
Right.
that money. Now you got to make sure that the capital gains doesn't kick off, put you into a bigger bracket.
Yeah.
So you definitely want to make sure that your tax professional and your financial service professional are engaged with you on that.
Yeah, for sure. I mean, you don't want to mess around with a capital gains tax strategy without having those professionals in your corner. Chris,
Yep.
I wouldn't want to do it without your advice and help there. You and Tarek help your
Yeah.
clients do just that, right?
Yeah. So
Yeah.
so that's the thing about taking advice off the radio. It's just kind of out in the ether, and it's not tailored for you.
Yeah,
Okay. So make
everybody's
sure
situation is different. So you
everybody's
need
got a
to
different
meet
situation.
with a financial professional.
Yes.
Yep, bottom
So
line.
that's our disclosure for this episode.
Yes, exactly.
So as we continue to get closer to the end of the year, you may also want to evaluate your Medicare thresholds. So there's this thing called IRMA, and you don't really know about it until that letter comes in the mail to you,
Yep,
unless
Irma.
you're listening to this episode.
Good old
IRMA.
Aunt Irma. I think I had an Aunt Irma once.
And so it stands for Income Related Monthly Adjustment Amount. So basically, it's a look back by Medicare uh, to determine how much money you're going to pay and Medicare Part B. So they look back on how much income you have. So if you're taking capital gains, you're converting uh, 401ks into Ross, that all that is taxable income. So it's determined by your gross income, not just your taxable income, right? So it includes a lots of different parts of your income. So you got to make sure that you're staying within the bounds on that. No, so here's a thing that's really important. If you're a married joint filer, it's a different table than if you're a single filer for IRMA. And IRMA is very punitive to single filers, I can tell you, because we have some. Even though this particular client is married, they file separately from their spouse because their spouse has a business and they don't want any of their things mingled, and so they keep them separate. And so we
Makes
have
sense,
to
I guess.
watch how much we convert because of IRMA and what
Ah,
it'll do to our monthly budget.
sure. Yeah, that's one I think a lot of people don't think about.
Yeah,
Is they don't understand, or maybe they've never heard of IRMA or those options, and you don't want to pay more than you have to. That's
yeah,
just finance 101, right? We all want to minimize our tax burden.
that's right. And if you create a plan for it, then you're not getting that punitive letter in a year and a half from Medicare.
Yeah. Yeah. Yeah, it all ties in. Taxes, Social Security, Medicare. People are
Yeah.
like, "Wow, you guys talk about those 3 things a lot." It's because they are intrinsically entwined with
Yes.
any financial plan and especially
Yes.
retirement plan.
Right.
Yeah.
So we mentioned required minimum distributions, um, and making sure that your retirement accounts are adequately funded. So RMDs aren't a choice; that you have to do it. That's why required is in the name. So when you have your retirement accounts, when you reach a certain age, you have to start pulling them out. So this year, if you were born between 1951 and 1959, your RMD age is 73. So if you're born in 1960 or later, your RMD age is 75. So that's good to know, and you got to make sure that you get your RMDs out to the government by December 31st. You got to get that check in the mail, because there is a penalty, right? And so you want to make sure that you're not paying that penalty. It's a hefty penalty now. It's gone down from what it used to be, but it's still 25% of what you were supposed to pay in. That's a pretty good hit. So um, and make sure that you're doing the RMDs. Try to make sure you're doing them in separate years. So I've had this problem where people extended the first year until April 1st of the following year, which you can do, but now you've got two RMDs required in the same year. So you want to take it, you don't want to use the extension. So the extension will get you out of the penalty, but it won't get you out of the penalty of having to take two and having to pay taxes on two in one
Yeah.
year.
Yeah. Yeah, RMDs can be tricky too. And
Yeah.
you don't have a choice with RMDs, but you still might be able to reduce your taxable income. Explain that.
Um, so so let's say you're 73 and have $1 million in retirement accounts,
Okay.
and you had 50,000 and maybe some self-employment income or something. Maybe you did some consulting. Um, you may be able to offset much of your RMD by funding a solo 401k. So that's something that's there. Um, there's just a lot of ways that you can manage how your RMDs come out, and then how you can mitigate how they hit. Now, remember we started by talking about the valley. How do we reduce RMDs? We use the valley to convert money into a Roth, into a personal Roth conversion, and that reduces it.
Okay.
Yeah. And
Well,
and
why don't we, a lot of this brings up questions. Why don't we take a moment to let our listeners know how they can get a hold of you?
yeah, so they can reach out to us at 719-210-4242. Give us a call. We'll set up that complimentary consultation. We've got a Money Booze book ready for you in the office. And we really enjoy getting to meet with new clients. And so I always have a smile on my face and greet you at the door. It's how we roll. Um, Visit
Nice.
us online at our website, nolanfinancialpartners.com, so you can get a look at us and you know who you're looking for. You can also find out more about our radio programs from about our past shows. You can subscribe on Apple Podcasts, Spotify, Google Podcasts, and music. Um, just check us out and then come to our office. Give us a call, 719-210-4242. So
All
during this
right.
episode, we've been highlighting potential end of year stuff, and so we've got a few weeks to get this done. So, but
Yeah.
we need to look at it.
Yeah, for sure. And you've given us some excellent insights already, Chris. What do you have for us next?
So, generally, contributions to a 401k are required by the end of the calendar year, right? So when you have to get them in. So payroll, it's a payroll withholding. It's a great strategy. You should be taking advantage of everything that you do there. Make sure you do it before the end of November because it may take 1 or 2 pay periods to process those changes, and so you may have to work with your HR on that, but, so this year, the 401k contribution limit is $22,500. If you're over 50, you can kick in an extra $7,500 as catch-up contributions for a maximum deposit of $30,000. Wow, that's a lot of money you can stick into a retirement plan in a given year. So, now increasing that 401k may end up significantly reducing your tax bill as well, right? Because that's $7,500 more that you're putting in there or $30,000 more. So if you say that you're in the 24% tax bracket, you would reduce your tax bill by $7,200 based on putting that $30,000 into an IRA, traditional IRA. So really look into that. There's a lot you can really help out your retirement and even your current spending plan, right? So that's a great thing.
Yeah. Yeah, that is a good thing. And I think that's really important. So, obviously, this is a lot. You've got to make sure your
Yeah.
401k strategy is set up and is ship shape. And that's another good reason to work with somebody like yourself, isn't it?
That is, you really want to get that set up so you understand how that works. I ran through the numbers with a client on that. Putting that extra $7,500 really only took about $400 out of their spending plan monthly because the way the taxes and the payroll taxes work, it only really took only out $400 a month out of their spending plan. Is like, do you want another $7,500 uh, of money that's going to sit there and grow while you're waiting to get into retirement for $400 a month? You get $7,500 more in your retirement system. Yeah, okay, let's do that. And so yeah, everybody that I talk to is like, yeah, I could do that. That's pretty easy. It doesn't hurt that bad. And then I've got more money for retirement. Because guess what? You make so much more money when after 50 than you do before. Usually most people can get that into their spending plan.
Yeah. Yeah, and I mean, obviously, when you work with somebody like yourself, there's no reason to go it alone. I mean, when
No,
there's that option out there, right?
that's right. You need to take advantage of that. And then the thing that goes along with that is RMDs, right? So you've got to make sure you're getting your RMDs paid out because of that 25% penalty. There's something to note here that's super important. this is a big foot stomper. If you've got a Roth 401k, you still have an annual distribution requirement. Now, not too many people that are 73 right now have Roth 401ks because they weren't available, right? But in the future they will. So the best thing to do is move that money into a personal Roth IRA. Okay, because personal Roth IRAs do not have an annual distribution requirement. There's
So
no
no RMDs.
no RMDs
and no
on a personal Roth.
taxes on a Roth IRA.
That's
but
right.
on a Roth 401k, there are. At least there are RMDs. There's still no tax.
There are RMDs, so you have to take it. So the government tells you when you have to pull the money out of your Roth 401k. They don't tell you when you have to pull money out of a Roth IRA. It's kind of written into the code, and they didn't really fix it, right? Because they started Roth 401ks, and then some of the old verbiage just came through. It's maybe they'll fix the code someday so that doesn't. It's a silly requirement because there's no tax event. So, but the best thing is to convert it, and you convert it. There's no tax hit on converting it to a personal Roth IRA. That's where you go down to your financial services person to make sure you're converting it correctly and getting it in within the right time frames and everything, because there are rules about how you do that conversion, and you want to make sure you're following that. So it's a really a great strategy move, if you happen to have a Roth 401k, is to get it into that before any RMD requirements hit your 401k assets.
Yeah. Well, and obviously, again, you want to make sure you're working with a professional. And I think that understanding how Roths work and how Roth 401ks work,
right,
especially before the end of the year, you want to look at those things and make sure that the tax situation is right, and you know where you stand, and work with a professional. Right. So what do you have next? What else do we need to know about before the end of the year as far as tax planning strategies?
So say you're covered in a this happens to a lot of our clients that have pensions, is that they have a required IRA distribution based on the government, and so they can avoid those taxes on that distribution if they move that money to a qualifying charity. And so that we have some clients that do that. So we usually look at it around tax time so that they understand what, they're thinking about money anyway. So in the beginning of the year, the people that want to do that, you can give up to $100,000 of an IRA charitable contribution to meet that RMD, right, out of that RA. And that way it's paid directly from your IRA to the qualified charity. You got to get it done before the end of the year. And then you won't have to pay any taxes on that. So if you've got some pensions, or maybe a business that sends you income that's part of your income, then this is a great way to avoid the income tax on those RMDs. Tony?
So charitable distributions are good.
Yes.
And you can have qualified charitable distributions, which is what you're referring to here.
Yes.
And you get the tax deduction. There's no taxes on that money if you have it put right from an IRA that you have a taxable account. So a lot of people pay tithe to their churches, right? Or they regularly give to charities. And so instead of cutting a check, which is a no-no, you want to have that money directly, especially if you're over 59 and a half, have that money taken directly out of your regular IRA or regular 401k accounts and sent directly to the charity. That way you don't pay tax on it. They don't pay tax on it, right?
Yeah. And you want to use those forms that your financial services professional can help you get for that, so that then you've got that log, you got that thing that here's where I sent it, here's what I directed them to do, it got sent, see, and then usually you get a letter back from the charity saying thanks. So you have that, so you can show that you did that charitable contribution.
Yeah. Yeah, it makes sense. It makes sense, and that's a huge way for people out there, for our listeners, to really save some money. I think a lot of people make that mistake. I see a lot of people cutting checks to church, to pay their tithe, their 10% or 20%, or to their favorite charity,
Yep.
and then they're paying after-tax money. They're paying taxes on that money, then giving it to a charity where you could have it. You can have qualified charitable distributions go directly from those taxable accounts to a
That's
charity,
right.
and you don't have to pay tax on it, which is, that's a win-win-win, right?
That is. It's a win for the charity, for the church, whatever nonprofit you're giving it to. Makes you you get a good feeling for doing that, right? And you're taking care of the things you care about, and then you're not having the tax man dip into that at all. So there's more effect of those funds, and you get your RMD taken care of. It's a
Yeah.
great way to do that.
Yeah.
Yeah.
I think that's
So
good. Well, hey, I wanted to ask you, we got about 3 minutes here, and just really
okay.
quick, another thing regarding taxes and planning before the end of the year. A lot of people, if you're like me, I'm in my 50s, so I'm of
Mm,
the age where I can make catch-up contributions into
that's
my
right.
401k and IRA. That's something you should look at possibly doing before the end of the year too, right? Or would you recommend that?
Yes, that's right. So if you've got a, traditional IRA or a Roth IRA, and you're over 50, you can put $7,500 into that. It's a catch up. People prior to age 50 can't put as much as you can. So it's a great time to put that in there, get that in there before, um, so you can count it against this year's taxes, and you get it out of the way and get it done. But get that contributions to those, the personal ones is $7,500, just like the kind of like it is for 401ks, except they have the part you can already put in. Um, so that personal Roth and that personal traditional IRA can be powerful tools because you get to determine how they're invested. And if they're not doing well, you can say, well, let's look at a different strategy for those funds. So maybe they'll do better. And that's a great thing about a personal IRA and a personal Roth is you get to manage how it's invested, what it's invested in, how exposed to risk it is, those kind of things.
Let's see. Yeah, that's yeah, you gotta I think it's really important that people out there put this kind of thing off, Chris, and they
Yeah,
don't think about these things. That's why sitting down with
yeah,
yourself, you and Tara, is so important. And I want to emphasize to our listeners, there's no catch. You can set up
no,
a consultation, and for the initial consultation, one or two, there's not going to be a cost or an obligation. But you're going to lay out, okay, here's where you're at. Here's what we think you should do. And if you want our help moving forward, here's, you're very transparent about here's what we charge, and here's what we can do for you. Here's, and they'll see. And I mean, every study shows that if you work with a financial advisor, a trusted financial advisor like yourselves,
that's right.
you're going to end up financially better than you would if you didn't. I mean, there's study after study after study.
That's
And
right.
so I think it's really important. People can make really costly mistakes, especially with end of year tax planning.
Right.
You have to work with a tax professional. You have to have a financial professional, though, as well, to look at the overall picture. A CPA will typically just take your information, fill out the online forms, and look back at the past year. They're not doing tax planning ahead of time before the end of the year with you typically, and
Right.
they're not looking forward to your retirement and how it's going to affect taxes then. So, again, great show today, but we're out of time. Is there anything else you want to add before we go?
No. So if you have any questions about year-end financial steps, we have a taxes and a power of win tool We just sit down and look at your stuff, right? And how taxes affect you, and what's the best thing to do about that. You can visit our website, call our office at 719-210-4242. We can discuss how we might be able to answer all your questions, address your concerns. If you make sure you mention the radio show, and don't let me forget to give you your free copy of Money Moves by Tara Nolan. So check us out at nolanfinancialpartners.com and give us a call at 719-210-4242.
All right. Well, Chris, great show today. And listeners, thanks for tuning in. That does it for today's episode of Nolan Financial Radio with our host, Chris McKinney.
Join us again soon for another episode of Nolan Financial Radio.